Hi there. Welcome to another update from MDH Accounting. I'm Michael Harvey. This update, I'm going to talk a bit about what's happening in the economy and mainly from a small business perspective, but just a general overview. And I've called this one Grocer-nomics. And little story when I was shopping the other day at Woolworths. And those of you who know me, Jenny and I love our Tyrrell chips. But I haven't been eating much of that lately because they haven't been on special. So I'm still accountant by heart. I was only buying the chips, even though I love them, when they're on special. And then last weekend in the shopping spree, they were at half price. I thought, wow, maybe it's just the optimist in me seeing that there's little green shoots that we've seen the back of the inflationary curve, as they say in the media and economic language, and we're starting to see some return to normal pay, maybe. But maybe it's just the optimist in me, and it was just a bit of a one-off special. But Old Gold was on special as well, my favourite chocolate. So it was a good shopping day. Even last night, driving home from work, I saw that petrol prices ran to about $2 a litre. So that's come back a long way as well. And where that stabilises at that price, who knows? So the Reserve Bank of Australia, the RBA, has been under the pump a bit at the moment, and probably rightly so. They misread the whole economic cycle we're in at the moment. And about 18 months ago, probably less than that actually, this time last year, they were saying interest rates won't go up until 2023, 2024. The reality of this is, for us all to see now, the interest rates are climbing and climbing rapidly, with the Reserve Bank putting up interest rates by 1.35%, I think, in the last 3 months, and likely to keep climbing. ANZ economists come out the other day, they're predicting another 2% rise between now and sort of early next year. Seems to be the consensus of what economists are saying. And even though this ING yesterday, as an example, dropped their rates by 0.15 on some of their products. So a little bit of confusion out there, but the consensus seems to be that we're going back into a higher interest rate environment. Where that will land, you hear sort of my parents' era, late 80s, early 90s, when mortgage rates were 18+%. How they survived through that period. And I suppose the reality is they survived, generally speaking. Things were tight. Paying that sort of percentage on your mortgage didn't sort of get ahead, but overall people sort of survived during that period. So we've got a lot of headlines happening at the moment. Property price crashes, corrections, whatever you want to call it. What's the share market going on? There's a correction, bull, bear markets, all that sort of analysis. Where is all this going to head with oil prices and the like? Lots going on in this space. So I think I was reading something the other day. One of the head investment bankers out of the States, they said it's a very sort of volatile period we're in at the moment, and no one really has a clear picture. Well, a few thoughts. I suppose at the moment, a lot of the headlines is playing off those fears of the confusion or the uncertainty that we're in at the moment. And I'm not discounting the volatility we're in. I'm not discounting the reality of, having to fill up your car and paying a lot more to fill that up. Groceries, power's going up, insurance is going up. There's some real things happening are stretching both business budgets and especially household budgets this time. So I'm not discounting that at all. But if we take interest rates, can they go back to the late 80s, early 90s, the 18% type stuff? They could do. But I've just got a few thoughts to share of some rationale why they may not go that way, and also why house prices won't go through the floor, so to speak, and that there'll be an adjustment, but not to extreme. So if we take interest rates, so the reality is RBA are fairly limited in what they can do in terms of the levers they can pull during this inflationary cycle we're going through. So they try and get inflation between 2 and 3%. At the moment, it's sort of 5 to 7% range. Yeah, UK the other day was at 9%, so it's not an Australian problem, it's a worldwide problem. So what do? They've pretty much just got to put up interest rates to try to quell the market or reduce discretionary spend or the general spending in the marketplace, and therefore prices will drop. So that it's a bit of a singular lever that they can pull, and part of that is they effectively play on the fear that interest rates are going to go through the roof. So by putting them up, everyone goes, well, it could get a lot worse before it gets better, and effectively try to stop them spending. I think the research would show that people's psychological perspective is if they've got equity and their house prices go up, they feel better and more likely to go and spend and stretch themselves, whether it's buying new stuff for the house, around the house, better overseas holidays, whatever it might be. We still need to eat. We still need to drive our cars. We're a nation of car drivers, essentially. So it is hurting the hip pocket. So the theory is that they won't need to put interest rates up as much as what they're thinking, because we're already suffering. People are slowing spending down because they're spending more on their grocery items, whether it's lettuce or chilled chips are not on special as what they once were, or whatever it might be. Eating out might be less frequent, or if you're eating out, you might skip dessert, or not consume as much. So watching your pennies that way. But I think most people are sort of aware where things are at and are trimming their cloth accordingly overall. So what does that mean if people are sort of slowing down their spending, especially slowing down their discretionary spending? Then for small business, if your primary customer or most of your sales revenue comes from a discretionary spend by consumers, then you're probably going to be in for a bit of a rocky, tricky period over the next 12 or 18 months, because there might be some lower sales volumes, or average spend per customer and stuff like that might be down. So it's just a little, I suppose, a thing to watch if you're in that space. So what will happen to property prices? We've sort of seen that the bubble's burst, the heat is coming out of the market, sort of a correction in the primary in the Melbourne, Sydney markets, but I think that'll flow on to other markets. Even in my hometown, Launceston, I think it was negative growth last month, first time for a while. I mean, you put it in context on the back of some unbelievable growth rates over the last sort of 24 months. So a correction is not out of order, but it makes for a good headline. So because we've had such a strong property price movement over the last sort of 2, 3, 4 years, most people got quite substantial equity built up in their home. Secondly, with the pandemic, people's savings went up. They weren't able to go overseas, whatever, so they've got ahead of their mortgage as well. So there's a fair amount of buffer, generally speaking, in people's equity position on their homes. It'll be a bit tougher for new or recent home buyers, first home buyers. It's probably going to be a really tougher period for that market. Bearing in mind, to some extent, all loan approvals had a 2%, which is, I believe, now 3% interest rate buffer built into the serviceability calculation. So in theory, there's that margin that interest rates can go up by that sort of level before there'll be a sort of severe impact. That assumes status quo for everything else. And as we've mentioned, a lot of household items have gone up as well. So it might be a bit of a squeeze for some people. But inflation is here, as I said, hurting the household budget. But will prices collapse for houses completely? 3 thoughts there why I believe it won't be as extreme as some of the commentary. The first is the fact of the employment market. So those figures come out for June the other day. So that's really, really strong figures. So what does that mean? It means that people are unlikely to lose their job through this sort of economic cycle. Therefore, banks are more likely to work with their customers. And for example, they might add a period to extend the period of the home loan from 20 years to 25 or something like that, and reduce the mortgage payments if they're under severe financial stress. If you've been the last couple of years sort of maxed out your mortgage, bought other things such as extra cars or higher level cars, caravans, boats, etc., there might be a bit of a rocky road for you in that. And some of those items as discretionary items might have to be sold off. That's the reality probably for some people, unfortunately. But I don't believe it'll be the house that be sold at fire sale prices, generally speaking. The RBA, in some commentary the other day, said in their modelling, take that with a pinch of salt, some might say, but I'll go with it, that their scenario of a 20% price drop for houses would mean that only 2.5% of mortgage holders in Australia would have effectively negative equity in their home. So there's still 97.5% have got 80% or more loan to value ratio, 80% or less loan to value ratio. Once again, the statistics don't look at the individuals. So if you are one of those 2.5%, then not much fun coming up. But for the 97.5% of mortgage holders in Australia, yeah, just sit tight through this storm, and it's not going to be the end of the world as we know it. Talked about the unemployment stats come out the other day. It's at 3.5%, which is the lowest rate for 48 years. So that's just unbelievable. You know, some commentaries that 3 to 3% is sort of full employment. It's pretty much right. I mean, in June there was 494,000 job vacancies, and in May there was 494,000 unemployed people in June, and 480,000 job vacancies in May. Nearly a 1-for-1. So it might not be the job that you're after, but certainly a job to pay the bills at least. So we're pretty much at full employment, which flows onto my second point, that the reality for small business and business in general is that we're in a very short supplied labour market. So therefore it's sort of fueling some of that through wage increases, and probably rightly so. The other day I was just reading a headline, there were 60,000 skilled migrant applications that are in the system that is clogged up for various reasons. So, you know, hopefully that'll all get resolved soon. And all of those people, and you can multiply that's 60,000 applicants, they're going to bring spouses and family, and for some of those, they've got to live somewhere. So underlying that is going to be the greater demand for housing from our migrant population that has sort of been plateaued over the pandemic when basically things dried up completely. A lot of sort of new housing construction was fed by migration. So I think once that tap starts to flow again, we're going to have sort of basic supply and demand equations with housing, and sort of keep a floor under the housing price, increasing demand for migrants. The third point about why I don't believe that property prices are just going to go through the floor is that even by the RBA's announcements recently, there's quite a lot of built up equity in people's homes, paying ahead of the mortgage. You know, the non-first home buyers, so the next generation up, they're quite cashed up in real terms. And so you're going to see some investors come back into the market. Rents are increasing quite dramatically, which is not good for non-homeowners. But as an investment sort of portfolio, your residential rent return, and especially if prices soften, you're going to see some investors come in at a certain price point. What that looks like, I'm not sure exactly, but I think there's demand for that. The other one is the Bank of Mum and Dad, which I think is the third or fourth or fifth most dominant lender in the home loan market, effectively. And they're not going to let their kids' houses fall over. So they're going to come to the rescue in some way, shape or form, and have got sort of equity in their own home. So, you know, it could be that they use that equity to help out the next generation if it's sustained interest rate hikes and getting pressure from the bank. So for those three reasons, I think there will be sort of stabilising influences on house prices. The fact we've got pretty much full employment, we're going to have an increased migration numbers underpinning the demand, and that we do have a wealthy sort of whatever generation that's called, sort of my generation, I suppose, and the people in their late 40s to 60s, that they've got a fair amount of wealth that underpin some price points as well as helping out when they can in the next generation. Pardon me. And that's just some thoughts around where we're at, and whilst there'll be some pressures around, but I don't see it as a dramatic collapses as what some of the commentary you see on the news reports at night. As a small business person, what does all this mean? So if your sales are coming from discretionary spends, you really need to have a think about what that looks like and sort of plan accordingly. Might be some more difficult times coming, unfortunately. Because of that discretionary aspect, retail, hospitality, tourism to some extent. All these sort of discretionary spend type of scenarios. Tight labour market, access to staff will just continue to be an issue in my view. The migration will solve that problem to some extent, but we're sort of pretty much at full employment. So short to medium to long-term issue for employers to try and grasp with. Interest rates will definitely have an effect on small businesses. It'll soften investment opportunities or decisions. And if you've got an overdraft working capital, that's going to obviously increase with the higher interest rates. And so things such as the amount of stock you hold, the product ranges you have may need to be revisited over this period to reduce your working capital requirements. And just the basic principles of working capital, your stock and your debtors as your sort of working capital assets, and less your trade creditors. Try and work in that space because the cost of holding that working capital is just sort of increased. Maybe even look at some refinancing options over this period as well, and reconsidering how to pay down some of that debt that might be sitting around. So these are certain thoughts for a small business perspective. Hopefully this has been helpful. A little bit of, as I said, Grocer-nomics, looking at the grocery aisle when I do my shopping and what that looks like. So thanks for joining me.